You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Well, we're getting close to mid-October here. Precious metals showing no sign of a bounce or a rebound. As a wise man once told me, the bear market that you're in is always the worst. And that wise man is with us right now, Bob Hoye. And Bob, great to have you back. So what is going on?
Yeah, hi, Kerry, and our listeners. Quite straightforwardly, Kerry, it is a post-bubble contraction. And there have been 5 previous great financial bubbles, starting with the South Sea bubble in London in 1720.
I remember
and
it well.
That one was invented. You know, there had not been a big stock bubble like that. So they just invented it, all new players. But the amazing thing, Kerry, is all 5, number 5 was 1929, and number 6 was the one that peaked in January. But the amazing thing is that each new set of players has been able to replicate the action of the previous set. And without knowing anything about 1929, or 1720. 1825 was an incredible bubble as well. So the work I did on this a long time ago is that there are features of the climax of a bubble beyond the stock market going straight up and huge volumes, new issues, and all that sort of stuff. But what you have is that real long interest rates go down during the bubble because folks are not buying just the stock market, they're buying bonds like crazy as well. Now, the other one is that copper. We got that one back to 1825. So you take copper deflated by the CPI, so you end up with the real price. And in the final stage of a bubble, copper's real price goes up, which it did. And then the really weird one is that in the final stages of a bubble, gold's deflated price goes down. And it did, and it's still down. And what the meaning of this on gold's real price is that it actually reflects profitability for gold miners. So the rule is that when the real price goes down, the costs are going up relative to what they're getting for bullion. And then when you get into the post, actually when you get into the post-bubble contraction, gold's real price goes up. And that improves profit margins for the gold miners. Not only that, but it improves valuations for exploration properties as well. So now in U.S. terms, and this is always calculated in the senior currency, now dollars, it used to be sterling. So gold's real price on the latest posting, which is just posted monthly, is still down. And but what we got a trick in June, I thought, well, why not compare it to commodities? So we took gold and divided by commodities, and man, did it ever get oversold? Because you post the damn thing daily, and we can use all our technical tools on it. So the gold divided by the CRB became exceptionally oversold, and which means that it's bottoming. So then now here, we've been watching it for 3 months, and the gold divided by CRB is basing. And we've seen this pattern before, like the gold-silver ratio in the first half of 2021 Also, the bottom in the U.S. dollar was the same thing. You went maybe 4 or 5 months as the item based, and then when it rises above its 20-week exponential moving average, that concluded the base. So we're very close to that now in gold divided by commodities. So also the work on this we did over a few years is that at previous lows for this gold sector, the rise in the gold divided by commodities index, it led by 1 month to 4 months. So the 4 months lead would be around October. So the gold divided by commodities index is very close to completing the base. It rises up through the 20-week, and now that's the positive for the sector. The problem is going to be is that the gold stocks themselves are still going to be vulnerable to any further hits in the big market. That's the way it works. But what we have done is in 1928, 29, and afterwards, we took the chart of then Homestake, which was the premier producer. Also, Dome Mines in Canada was a major one at that time. And compared it to the S&P at that time. And the gold stocks go up and down with the big market as the bubble crashes. But then once you get past the more immediate problems, then the gold stocks outperform the S&P on the rallies hugely. So what I'm looking for then, as a matter of fact, last week, for the first time, we put out to begin accumulating gold stocks. There's no rush to get in. The gold pundit they're all confused because the U.S. dollar's strong. And here, this is another main feature of a post-bubble contraction is that the senior currency goes up. So then one would say, well, how can we be bullish on gold? Well, I don't bother with looking at gold in dollar terms. I look at it in real terms. And then when it turns up, that's what improves profitability. Now, there's another aspect on this, Kerry, is that the standard, the orthodox, the conventional way of looking at gold stocks is based upon the U.S. dollar going down. That has been the basis since Jim Dines really started talking about gold in the mid-1960s. But what you are doing then is if you're positioning gold stocks hoping for a decline in the U.S. dollar, you're essentially positioning based upon foreign exchange changes. So it's a speculation in foreign exchange. But when you look at it on gold's real price, which relates to real earnings, you're then buying the potential of an increased stream of earnings, and that's investing. So all of these orthodox guys in the gold business who are always hypothecating a crash in the U.S. dollar, they're speculating, whereas our method in looking at the real price and beginning to get positioned in golds is investing in the sector. And so what is ahead once the gold market really turns and starts to go up, the gold stocks, is that they will be outperforming the S&P. So I've worked with financial institutions for decades, and so what's going to happen there? You're going to get an equity fund manager guy who would normally not be interested in golds, but if you get 2 quarters of the gold stocks outperforming the S&P, they're going to have to get into it. So it feeds on itself. So what the course would likely be, Kerry, is a lengthy bull market for gold, Of course, with the usual intermediate swings, but lengthy. I mean, many business cycles long. 10 years kind of thing, and where on the rallies, the gold stocks will be outperforming the S&P and making people a whole lot of money. So it's an interesting prospect. And as I said, it's just last week that we suggested to begin accumulating your favorite gold stocks.
Okay.
So as a matter of fact, I put together a list of about, I guess, a dozen small cap gold stocks. And I haven't done that since 1995. And with John Embry, who I've known for a long time, we got a list, 5 junior explorations, and one of them was Arequipa. And it went from pennies to about $30 or something like that. I mean, it was the takeover was at $1.1 billion. So you only need to have one of those. So if anybody's interested, they can just get in touch at bobhoye.com, and we would be pleased to send that list out. It's highly speculative stuff, small cap gold stocks, and illiquid. Just
well, you're preaching to the choir here, Bob. Of course, right?
Kerry, I got myself through university a degree in geology and geophysics ages ago with summer jobs working in the field for junior mining promotions. And then I've played the game since, so I really like the sector. As I said, it got me through school, and it'll get me through retirement.
All right. Well, you're a little bit partial, but that's what we like. So,
yeah,
deflation. You predicted copper coming down, oil, basically all commodities they have. Are they done retracing? Because we had like huge PPI number in the States here today, 8.5%, and that's understated.
Yeah.
So just because commodity prices go down doesn't mean inflation follows, does it?
Oh, no, it will. I'm convinced. The full recession isn't in yet, and post-bubble recessions have been severe. I mean, things really shut down. So I think the CPI inflation will come down.
Really? How much?
And the other one, I'd say the feature of a post-bubble contraction is that real long interest rates come down, and they did, and then they go up. And now they're screaming about this is the biggest increase in interest rates in any number of generations. But again, we use the real interest rates. You just take the 20-year Treasury and deflate it, and you end up with real interest rates. Now, this is on the latest reading. That's not one of these things that are published monthly. Is that the real interest rates have gone up, but only about 2 percentage points. And in previous post-bubble disasters, that increase has been 10 to 12 percentage points. It's the worst disaster in bonds that you can imagine. So this is still ahead of us and the reason why the bonds get hit so hard, particularly lower grade bonds, is because they were issued in a mania. The world was buying bonds recklessly, and then comes the problem trying to service the debt, and which becomes impossible. So there's a whole lot of junk bonds going to default, absolutely zero. And then many investment grade bonds will be downgraded to junk, and then they will fail as well. So on while the stock market gets all the noise in the bubble, the action in the credit markets is even bigger and more telling. Now, getting into the credit markets, Kerry, is that many have been talking about the yield curve and inverted, whereby short rates get higher than long rates, and that I look at as a function of the demand for speculative money, short-term stuff, and that raises the T-bill rate. And then the Fed has to go along with it and raise it. So, and it's still going up. Geez, I looked at the 3-month bill rate this morning. I think it was up to 3.49. So it's still going up, and that's the way short-dated interest rates go. When they're on a trend, they're there until all of a sudden they reverse. So the action in the yield curve is that when it inverts, a recession is inevitable. And uniquely, I've got the yield curve back to 1867. So you cover the 1873 bubble and the 1929 bubble, and then any number of bull markets since. So there's two main rules on the yield curve. Number one, if it inverts, you get a recession without fail. And I'm sticking with that one. Number two is that the dynamism, like the strength of how fast the curve is inverting, is also important. And the more zest you got in it, the harder the crash will be. This thing is not full zest, but it's up there. So it's quite, just looking at the yield curve, you can say there will be a recession, and it will be a severe recession. So,
Boyd, are we do you think it'll be on the scale of 1929?
Don't just survive, thrive. The Financial Survival Network.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million-ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well-positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Oh, man, that was unique. Well, that one was incredible because 1929, the New York Stock Exchange was an outlying stock exchange. Like London was the financial center. So the London Stock Exchange index fell in half with the crash. And either you look at the Dow or the S&P, and because it was a junior market and highly speculative, what was the full crash was 87% or something like that. So a 50%er for the S&P is quite likely.
Okay.
And then for other sectors, as we've seen, the wild stuff, Bitcoin, cryptos, and all that sort of stuff, and any number of things, the crash is going to be in the 80 to 90% range, if not, and that's for the stocks that are still trading.
Well, I was going to send you a NFT for Christmas, Bob, but by the time you get it, it might be worthless.
Oh, that's funny. That's a good.
Hey, so.
Well, those things were amazing. The most amazing things have happened.
Yeah.
But what we want to look at is for most of this year, the pundits have been on that 1970s type of inflation. And there's even one big name who called for a Weimar hyperinflation. I'm going to stay with the note that the hyperinflation has been in financial assets,
right?
And that is easy to demonstrate because you take the German 10-year note; it got to minus interest rates nominal. It was almost minus 1%. And in thousands of years of history of interest rates, you've never had a negative nominal. So that was hyperinflation in bond prices. And then in previous bubbles like the South Sea Company, its big swing was about 10%, a 10 times gain. And if you look at Radio Corp of America in 1929, that was a tenner. But in the crypto and the Bitcoin, those percentage gains were off the map. And that was for big cap items. Now, in previous bubbles, you can get a mining promotion go from pennies to say 20 or 30, which is percentage-wise immense. But it's not a big cap deal. Whereas the crypto and Bitcoin was huge cap with unbelievable percent gain. So that to me confirms that the big inflation has been in stocks and bonds. And the reason to focus on this, because every previous bubble, once the party was over, you went into a severe post-bubble contraction. I mean, this is nothing so far. And so where most asset prices deflate, and you've seen what happened to crude since last summer. Now, I think it was the middle of June, I came up with the bear gets everything, including crude oil, gasoline, and natural gas. Now, natural gas has become a bit exceptional because of Europe, but nonetheless, crude made a very good high, 130, and is traded down into the 80s a little while ago.
So
and there's more down for commodities.
All right. So, Bob, in the 1929 and the 30s, we had these bank runs. We had banks closing up. Are we going to see a replication of that, or will they just print money to keep them afloat?
Again, the 1930s in North America was exceptional because you not only had a post-bubble depression, but you also had a whole farming community that suddenly became uneconomical. So in Europe, you didn't have the disaster in agriculture where people were forced off the farm. So the 1930s, in many ways, was exceptional, but the main thing was it was a post-bubble contraction. And but commodities head down. But then we want to go back to the big commodity booms in 2008 and 2011. And at the time, of course, we cover the base metal prices thoroughly because we've had major mining companies as subscribers. So I took the, copper, lead, zinc, and deflated them by the producer price index. And the gains in 2008 for base metal prices were not only huge in real terms, they were double any previous bull market in a 100-year chart. So the way bubbles work is that you have a huge global boom in commodities. The last one was 2011, and then a decade later, you'd expect a great financial bubble to erupt and complete, and it did. It completed in January. Now, going back, the huge global boom in commodities peaked in 1920, and it drove the U.S. rate of inflation up to something like 22 or 23%. And then in the crash in 1921, the global crash in commodities was so severe that the U.S. price inflation crashed to something like minus 14%. So then you had the Fed there absolutely riveted by the always existing fear of deflation. So the Fed was monetarily very easy through the 1920s. They had no understanding of financial bubbles then. So the Fed was pouring gasoline on fires of speculation. Now, what happened this time around? You had the last big commodity boom, 2011, and then for most of the following decade, the Fed was, inflation's not high enough. We're concerned about deflation. So they kept the monetary spigots open, not understanding that the play was in stocks and bonds. So this is where you've had the huge, extraordinary rallies in equities and in bonds, and these were the inflated items. So the crash in the long treasuries and junk I've been calling that as after being inflated, bond prices are deflating. It's a little play on words. So, but I don't see anything. I don't see anything that says that the path we're on is going to be altered. One, the central bankers haven't got a clue about what they're doing. And the only thing they know is to try and inflate money supply. But there's a wonderful editorial in Barron's from July 1932. And in it, the main argument is that, now, July 1932 was the absolute bottom. I mean, it was the bottom for bond prices, and it was the bottom for equities. That was the worst of the crash. Then you had the post-1937 bear market. But at any rate, Barron's editorialized that every anti-deflationary measure taken by the Fed is seen not to work. And the anti-deflationary measure was the Fed buying bonds out of the market. So this is where the academic economists in the 1960s started going on about that the Fed made, the policymakers at the Fed made a blunder by being deliberately tight. Now, what the economists, particularly macroeconomists, need is a central bank to carry out their experiments. So then they couldn't criticize the operations. They couldn't criticize the Fed as a central bank. So they downloaded on the guys who were running it. But then when you look at that Barron's editorial, the Fed was easy all through the contraction. But with once you get the big crack in the markets, the power shifts from the central banks to the margin clerks. And that really proved it on that one. So this is still ahead of us, whereby the decrease in most asset prices will overwhelm the Fed's attempt to boost the markets with credit. It just ain't going to happen. And then you have the other problem that the dollar now being the senior currency, it's going to continue unrelentingly strong. For ages, we've had a target of 120 on it. That's just a number picked out of thin air, but it does show that that very much higher for the U.S. dollar relative on the DX is possible. So I'm just going to do another criticism on the standard gold pundit story. Is they're still waiting for miraculously the U.S. dollar is going to crash to zero and gold's going to go to 20,000. And when we're at the early stages of one of the best bull markets in history for gold stocks. Each of them, the previous bull markets for gold stocks were absolutely incredible. And then plus within that, you had the excitement of discoveries being made, which will be made. But to give you an example, Homestake in the late 20s was producing constant grade and constant rate of production. And with the boom, their costs went up as copper went up. Copper became a big play. So the miners wanted higher wages, and there was the cost of energy and the cost of equipment and everything else. So their costs were going up. But the price of gold was fixed at $20.67 a share. So Homestake lost some money in 1929. And, of course, then the stock got whacked with the crash. I think 8 1/8 was the low. But you could buy it. I bought it at $9 through 1931 and 32, or all through 31. And if you take this then to the end of 1932, because in March 1933 is when Roosevelt started screwing around with the price of gold. But by the end of 1932, Homestake stock was up something like 130%, and their earnings were up approximately that as well. and the price of gold was $20.67 an ounce. But because base metal mining was in such a contraction, equipment and miners were cheap. And then also the oil plunged relative to gold. So then, that energy costs are something like 60% of a mine, 30% for actual energy and 30% for blasting and stuff like that. So here you are. This is the proof that the real price counts because, as I said, the terrific rally in Homestake was done with no change in the price of gold. It was still at $20.67. So then in March is when Roosevelt began his crazy experiment with raising the price of gold relative to dollars. And they got it up to 35 an ounce, and then he became bored with it. But what did the gold stock do with the rising real price? Homestake got up to $65 on a $9 purchase. And get this, Kerry, at the time, gold miners paid out virtually everything by way of dividend. It was the way it worked in those days. So through the mid-1930s, you were getting not only the gain from 9 up to the 60s, but you're getting $4.50 a share dividend each year, again, against the $9 purchase. So you can see why we're so bullish on gold stocks once they really turn. Is that and it doesn't matter. At some point, the reform movement that's going on against authoritarian governments will continue to be successful, and part of that reform movement will be disciplining central banks by putting them on a gold standard. And I believe that will happen. But then this method of analysis continues to work. You just look at the real price. Okay. So you can take maybe 125 years in England when it was on gold convertibility, no change in the price of gold. But if you deflate the price, you get the story that I've been telling through each of those bubbles.
All right. So, Bob, we got a little bit more time. I got one more question. Do we see mass defaults? Because we're so leveraged, hyper-leveraged. Are we going to see mass defaults around the globe?
Don't just survive. Thrive. The Financial Survival Network.
Goldterra Resource Corp is a gold exploration company that has assembled a highly prospective district-scale land position on the doorstep of the city of Yellowknife in Canada's Northwest Territories. Goldterra is currently focused on expanding and delineating gold resources at the company's Yellowknife City Gold Project, with a goal of discovering over 5 million ounces. With ready access to infrastructure and multiple high-grade gold discoveries, Goldterra is on track to re-establishing Yellowknife as one of the premier gold mining districts in Canada. Goldterra trades as YGT in Toronto and YGTFF on the OTC. For more information, go to goldterracorp.com. That's goldterracorp.com.
This is the Financial Survival Network. The information you need to thrive. Now more than ever.
Oh, yeah. Individually, sadly, companies and municipalities, states, provinces, and even some federal governments. Province of Alberta, the federal government in Canada allowed them to default in 1934. So, and banks, now, yeah, you asked about banks failing. They will contract. Now, in the U.S., you had a pretty loose banking system where banks had to operate within one state. So you didn't. Now in Canada, banks could operate across the country, so you had geographic diversification. And also the banks, when they originally set up in Canada, they were set up soundly, like the directors were liable for the amount of money they put in, that sort of thing. So you had a much sounder banking system in Canada, but many branch banks shut down, but there were no failures of the big five banks in Canada. Whereas in the U.S., the failure rate got into the thousands because they were tiny little remote banks. Now, banks will contract. The money supply will contract. It's a credit contraction, and most asset prices will go down. So to put a wrap on it. So.
All right. So real estate too?
Oh, real estate indeed. Yeah, I ended up with one really good historical chart of real estate, and it was farmland values in England from the top of the 1873 bubble. The study was specifically 1873 to the end of that depression in 1895. And, my memory on this one, maybe the index was at 58 in 1873, and maybe it was 38 in 1895 at the bottom of the depression. Farmland values in England. And without 1 year of an uptick. So it was just steadily down. So, yeah. And people have been buying farmland in Canada and the U.S. like crazy, and Bill Gates particularly, and I think he's going to get stuffed on it. So
I feel terrible about that one, and probably as Moderna stock will become worthless as well. We can only hope. Hey, so...
I wish him all the worst.
I wish him all the best. What about China? Because if there's one beneficiary of the hyper-leveraged global economy, it's China. And we already see the implosion of their real estate market. It's just dead in the water, right?
Absolute disaster. You know, in the 1873 bubble, railroad stocks were the darlings, and then and you had to have a railroad, and they're putting railroads in everywhere. And after the crash, Vanderbilt observed that no point in building railroads from nowhere to nowhere. In the case of China, they've been building roads and railroads from nowhere to nowhere, and nowhere at each end they built an empty city.
Yeah.
So this is a disaster that is yet to be fully realized.
Yeah. Well, that I find fascinating. People never learn, do they?
No. Once you get carried away in a bubble. Oh, and I've just finished chapter 8 in my book, and it deals with famous people in infamous crashes. And even the great Isaac Newton, the physicist mathematician,
he lost everything.
He was an experienced investor, and he got in the South Sea bubble. In his first trade, he doubled his money, or made a good gain, and then got out. Then later on, got caught up and was buying high. And then even later on, he was advising a big wealthy estate, and that estate had more complete records than Newton had, and they were buying South Sea Company on the way down. Mm-hmm. And he was apparently quipped, "I can figure out the motions of planets, but I can't figure out the emotions of people," or something like that. So,
well, that's like Einstein.
So everybody gets caught up in the mania, and then everybody gets trashed.
Yeah, so that's like Einstein could never quite grasp compound interest, right? The miracle.
You can say that. I think I'll take a review of Einstein and see if he actually did anything in the market.
Could be apocryphal.
There could be something.
To him, it was more of a mystery than relativity. But
I think Einstein was one of the most. I think Einstein was one of the most unique thinkers in history. I mean, that was not his major step out in quantum mechanics was not based upon anything happening. It was all him figuring it out. Mm-hmm. I mean, there's a huge step from Newtonian mechanics, I'll tell you. So, okay, you're going to get me to look into Einstein's financials.
I'm sure it's apocryphal. But it's probably propagated by some stockbroker or something, or some financial wizard out there. So Einstein can't even figure this stuff out, right? Hey, well, it's like it's like marriage. But you know who invented marriage?
Well, Newton was brilliant, and. Also, it's not widely known that he was appointed as the master of the mint in London.
Yes.
And he then cleaned up, and hitherto England was sort of on a bimetallic standard, sort of silver and gold. And then he just said, no, it's gold. And then he made sure that the coinage was sound. And he was a very able administrator. And he was a very able investor. But he got sucked into the South Sea bubble.
Yeah, well, hey, he had the global picture of the economy, but it wasn't too good on the up close and personal. Well, that is it for us today. But I was going to tell you, the guy who invented marriage, people always think goes way back. It was actually a broke lawyer in Rome looking for his next payday and named Matrimonius. And on the sly, he also invented divorce. And a few years later, he died the wealthiest man in Rome. But that's a story for another show. Bob, really appreciate you coming on.
Kerry, anytime, look forward.
All right, just Google Bob. And Bob, where can you get that report that you just put out?
Yeah, Bob Hoye. Just Google it, Bob Hoye, Hoye, or bobhoye.com.
Okay. Well, we're going to request one today, okay?
Yep.
All right. Thanks, Bob. Any questions for Bob?
Yep.
Shoot me an email, kl@kerrylutz.com. Bob, we'll talk to you again soon.
Okay, Kerry. Yep. Bye.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.